Person. It's a real honour and a pleasure to meet you today. So look, before we talk about some of the big issues that you need to face every day in your job, tell us a little bit about AIM as well. We're going to speak to Marcus later on, the head of AIM. So, but it's an amazing institution and has weathered the test of time way better than many counterparts.
Absolutely. Well, firstly, thank you for coming into the exchange. Welcome back.
Thank you.
And thank you for coming to our birthday party.
Thank you very much.
AIM is a remarkable British success story that I think we should celebrate far more. It was designed to be the growth market for the UK and has been a phenomenal engine for growth in the UK, creating 68 billion of value added to the economy, 750,000 jobs in 2023, and over 5.5 billion of tax revenue. Now, that's what markets do, actually. We can talk about them as basis points and big cover ratios, but fundamentally it's to drive capital into the companies, and in the case of AIM, the growth companies in the UK and around the world who come and use AIM in order to enable them to fulfill their ambitions, to create products, to drive growth, to create employment, and to create solutions to people's lives. And that's what AIM has been doing for 30 years, and that's really what we want to celebrate today.
Julia, it seems to me that AIM is a metaphor, is a microcosm of the broader challenge you're facing here at London Stock Exchange, whether it be the small and medium-sized companies, or whether it be the titans you're trying to get on the exchange and keep on the exchange as well. I read the article, which, I mean, you would have read a couple of times, I'm sure, from December the 7th, and the headline was in the Times, Julia is on a mission to save the London Stock Exchange. Does it feel like that every day, given the wealth of news we're getting?
We're on a mission to make the London Stock Exchange the most vibrant market that it can be. That's simply put what we do every single day and what the hundreds of people who work on the exchange do every day. Fundamentally, when I joined the exchange, I said I want to do two things. I want the London Stock Exchange to be a driver of the UK domestic economy and a driver of the UK's place as a global financial centre. I think actually over the last few years we've got less good at talking about the former and more focused on the latter. And fundamentally, stock exchanges and primary exchanges in any country are there to drive capital into the growth economy. And we have disconnected ourselves as a nation from our market. Retail doesn't participate in regulated markets as much as they do. For example, we have 5 million crypto accounts in this country. And therefore, the average person walking along the street is not necessarily feeling that they've got a stake in the success of British business. And yet they do because they're employed by them. They do because they create growth and other investment in their area. They do because they create tax revenue for them. And so a lot of what we're trying to do is to reconnect those things back together.
OK, there's a lot to unpack there as well. Why don't I just go directly in here as well? You've got the City Minister coming up later on as well. You and I were talking off camera about the things that Rachel Reeves could do and Rachel Reeves won't do as well. Come on, what's your number... I know you're going to speak to Emma Reynolds, the City Minister, later on, but what is the number one thing this government could do that's in their power to do?
Well, I think fundamentally we've had an enormous reform agenda over the last 4 or 5 years in the UK, more than any other nation in the world, actually, and we have really made our markets match fit. The thing that we are most focused on, and I call it the 2 Cs, are capital and culture, is making sure that we're really driving domestic UK capital into risk investments. You know, we talk about risk as a bad thing, but the deployment of risk capital is the thing that's created all the companies that list on this exchange and that have grown our economy over hundreds of years. So it's not a bad thing, it's a fundamental thing that needs to be part of the makeup of our investing capability as a country. We have taken away quite a lot of the structural incentives for the deployment of risk capital in the UK over the last 30 years.
Are you blaming George Osborne for cash ISAs?
But I think we have done this. So it's not as if we didn't used to do this, but we have removed those incentives. And we've also created a language of risk rather than a language of the opportunity that comes from investing. So I've used this phrase a lot. We've so protected people from the downside, we haven't exposed them to the upside. And as a nation, we haven't had a conversation about the opportunity cost of that. So I think that the real ask of government is to think with an investment mindset. They are absolutely focused on growth, and that is about incentivising flows of capital into the UK that is UK risk capital that can drive that growth.
And are you expecting changes to the rules which enable pension funds to take on more risk?
Well, we're already seeing that. You know, between the combination of the Mansion House Compact and the Mansion House Accord, what's happening in terms of the consolidation.
Why are they so low then in the UK?
Well, I think we got ourselves into a regulatory kind of challenge in part in terms of de-risking and the language of de-risking. We also, unlike any other nation, had a radical restructuring of our pension funds when we started closing our defined benefit pension schemes for corporates and turning them into de-risking assets that invested in gilts. Let's be clear, almost no other nation on the planet did that. And therefore, we do actually need to make a more overt step back into the incentivisation of the deployment of risk capital, because we made such an overt step to reduce the deployment of risk capital with our pension reforms in the 90s.
They're already telling me there's only a limited amount of time. I'll keep them at bay as long as possible, Julia, because this is the conversation as far as I'm concerned. Why are we still seeing a lack of IPOs and concerns about delistings and de-equitisation on the London market?
Well, I think in terms of IPOs, we've seen a downturn globally. The pipeline for London is actually growing pretty rapidly. Now, I know that some of that isn't seen. It's a bit like an iceberg. It's below the surface. It's with the advisors and with the lawyers and the accountants at the moment as firms prepare. But that pipeline is building very rapidly, and from around the world, because I think the reforms that we've seen in the UK has actually enabled the UK to be a really compelling proposition. In terms of delisting, we do know the growth of the private markets and the strength of the private markets. And my view as a CEO of the exchange is not to sort of be King Canute and try and hold that back. It's to recognise that both private and public markets need to work together and we create a funding continuum in the UK.
And is that the Pisces initiative?
Exactly.
But then if you have the Pisces initiative, does it undermine AIM? And ergo, is AIM better placed outside of the London Stock Exchange, as a former head of AIM might like?
Yes. So,
there's a line in there.
So AIM is not for sale. We have this vision of a funding continuum in the UK. I think the hardest thing a founder should do is come up with a great idea and figure out how to execute it, not to try and navigate the labyrinthine world of finance. Our job is to create a funding continuum in the UK so you can get on it and navigate your way through. Pisces sits at a much earlier stage of that funding continuum than AIM does. AIM and the main market enable you to raise primary capital. Pisces is purely for secondary. And I think that there is a therefore logical transition between all of them. And we are absolutely committed to the next 30 years of AIM, let alone the previous 30.
When you see a company like Wise, that I've been quietly dismissive of them wanting to go to the US, because this is the company that trades on 30 times forward. Do you think the expectations of some of these technology companies, they're way out of kilter with actually what they can produce in terms of growth, in terms of profits as well? 30 times forward, that's more than most big US tech companies.
Well, I think that illustrates exactly the strength of London. You know, a company is.
So what are they thinking? Are they deluded?
I think there are idiosyncratic reasons why any company makes choices, and we have to recognise that every company is making a choice for what they believe are the right reasons, and the nature of their cap table is specific to them, and the nature of our rule set and how it interacts is specific to them. So I think I'd treat it as that. But I would take the opposite, which is that Wise is an illustration of exactly what this market can do, and what it can do for the next generation fintechs that are coming up in the UK.
But we just want them to get to FTSE 100, don't we, rather than seeing the de-equitisation? That's the problem.
And actually, to be blunt, those next generation of fintechs are going to find it a darn sight easier to get into the FTSE 100 than they are into any of the major indices in the US. And they will be the national champions for the UK.